All right, let's jump right into this explainer. Today, we are unpacking Sidus Space. It's a publicly traded company that is currently presenting two incredibly different narratives. And honestly, it really just depends on where you look. On the one hand, you have this exciting story of cutting-edge satellite launches and massive strategic partnerships. But on the other hand, there's a highly complex financial web that critics argue is designed a lot more for capital extraction than actual space exploration. So we're going to impartially evaluate exactly what's going on here. We'll examine their own press releases right alongside deep financial analyses and SEC filings. We want to look closely at their recent revenue trends, how their operations actually work, and try to answer one fundamental question. Is Sidus Space an innovative orbital pioneer, or, as some critics are suggesting, a zero-profit capital void? To really understand Sidus Space, we first need to look at how they pitch themselves to the world. They position the company as a vertically integrated space and defense tech powerhouse. They don't just build random parts, they boast flight-proven tech, AI products, and they even manufacture and operate their very own satellite and sensor system, which they call LizzieSat. They have this trademarked mission, Space Access Reimagined, and the goal is to provide flexible, low-cost satellite services to both government and commercial clients. And the leadership team is incredibly optimistic about this. Just listen to what Carol Craig, the founder and CEO, has to say. She states, "Our smart, vertically integrated model spanning hardware, software, and data positions Sidus to adapt at the pace of technology. The whole PR narrative here is heavily focused on rapid innovation, AI-driven edge computing, and extreme cost efficiency." And if you look at their announcements, Sidus is actively promoting a massive volume of operational milestones. They're securing additional launches with SpaceX, they've advanced a massive $120 million agreement with Lawnstar, they're partnering with Simera Sense on AI-enabled hyperspectral missions, plus they recently announced successful on-orbit operations of their AIS sensor on board LizzieSat 3. If you're just skimming the press releases, it absolutely paints a picture of a company with explosive commercial traction. But here is where we have to pause and ask the big question. Building, launching, and maintaining satellites, that is a notoriously incredibly capital-intensive business. So with all these ambitious projects and high-profile partnerships, how does a vertically integrated space company actually fund itself? Well, when we look past the hype and open up the company's financial filings, the narrative shifts pretty dramatically. Let's look directly at their 10K filing with the SEC. This is the objective financial reality. Even if top-line revenue exists, the costs required to generate it are vastly outpacing the money coming in. In 2024, the company reported a net loss of over $17.5 million. By 2025, despite all those announced partnerships and launches, that net loss widened to over $29.4 million. That is a massive 68% jump in net losses year over year. And then, look at their adjusted EBITDA for 2025. This metric is super helpful because it gives us a clearer picture of their baseline operational profitability by stripping out things like interest, taxes, and depreciation. It sits at a staggering negative $17.2 million. This number vividly illustrates the intense cash burn reality of their day-to-day operations over the last fiscal year. It really forces you to ask, how long can a burn rate like that actually last? This brings us to a highly critical perspective from independent financial analysts who watch the stock. One analysis points out, quite bluntly, the business does not fund itself through operations. Instead, it repeatedly taps equity markets while riding hype in space, defense, and technology branding. In other words, critics are arguing that Sidus relies heavily on selling its own stock to survive, rather than generating operational cash flow from paying customers. So let's look at Section 1, the Craig money play, and following the revenue. Critics have dubbed the company's internal financial mechanism the Craig money play. And to understand why, we have to look at how money flows in a very specific circular loop between four entities: Sidus Space, CEO Carol Craig, and two of her private companies, Craig Technical Consulting and Craig Technologies. The loop works like this. First, Craig Technical Consulting wins a customer contract. Second, they subcontract that work over to Sidus Space. Third, Sidus books this as revenue, but a lot of it doesn't arrive as actual cash, it just sits there in accounts receivable. And finally, because Sidus outsources its assembly back to Craig Technical Consulting, Sidus ends up paying most of that money right back as the cost of revenue. In the finance world, this is known as a related party transaction. Now, to be clear, it is perfectly legal, and Sidus completely discloses it in their SEC filings. However, from an investment and growth perspective, it raises some major red flags. Critics point out that because of this arrangement, the CEO is effectively playing the role of the landlord, the lender, the supplier, the main shareholder, and the main customer for Sidus Space. That's a lot of hats. And this brilliantly illustrates the big disconnect we're exploring today. The outward public perception driven by all those announcements of multi-million-dollar agreements is that revenue is being driven by broad commercial demand and diverse, independent government contracts. But the internal financial reality shows that revenue is largely a controlled channel relying heavily on the CEO's own private entities. And critics argue that this structure seriously stifles genuine organic commercial growth. Which brings us to Section 2, dilution and growth impact. So how does this related party loop practically impact the company's real-world growth? Because so much of this related party revenue sits in accounts receivable, instead of converting into actual usable cash in the bank, Sidus faces constant liquidity pressure. They have to borrow against those receivables just to fund operations. And when that isn't enough, they constantly rely on rapid equity offerings. That means they create and sell more shares of the company to raise cash. Analysts note that this increases structural complexity and results in ongoing shareholder dilution. Basically, every time they issue new shares to keep the lights on, the value of the existing shares gets watered down. You can literally see the price tag of this strategy directly in their filings. This excerpt from their 2025 10K shows hundreds of thousands of dollars, specifically $642,680 in 2025 alone, spent entirely on capital raise expenses. As critics point out, the speed and frequency of these offerings indicate that issuing equity isn't just a backup plan for Sidus. It really appears to be their primary business strategy for survival.
Section 3, stars or a black hole.
So we have to weigh these two realities against each other. On one hand, you have undeniable technological achievements. A physical LizzieSat actually orbiting the Earth, successfully capturing data and proving its tech works. But on the other hand, you have a financial reality showing a nearly $30 million net loss and incredibly deep structural complexities. The physical satellites are successfully launching for sure, but the operating losses are deepening just as fast. Now, Sidus Space's pitch to the public and to its investors remains highly optimistic. Their investor relations materials state, Sidus continues to strengthen its position through disciplined growth, demonstrated heritage, expanded contracts, and a vertically integrated model designed to scale with mission-critical demand. They also frequently point to a strengthened balance sheet, noting that they raised $53 million in 2025 and highlighting improved cost efficiency per satellite. But immediately following that, we have to acknowledge the stark warning from critical analysts who are reviewing the exact same data. They conclude, and I quote, investors are stepping into a machine that requires their capital to keep operating, a so-called space company that will likely never launch into profitability, but that will probably get confined into a financial black hole. To them, it is an empty narrative fueled entirely by shareholder dilution. We've looked at the ambitious hardware currently up in orbit, and we've analyzed the circular revenue streams and the widening financial losses down here on the ground. So I'll leave you with this question to ponder for yourself. Is Sidus Space genuinely laying the groundwork for the future of orbital data and defense infrastructure, or are they engineering a financial void that simply consumes capital? Thanks for joining me for this explainer. Keep learning and always keep looking at the data.